Okay, let's look at this intra-entity income tax situation. I'll read the problem to you. Lake acquired a controlling interest in Boxwood several years ago. During the current fiscal period, the two companies individually reported the following income, exclusive of any investment income. So you see Lake had $360,000, Boxwood had $90,000. Okay, then Lake paid a $60,000 cash dividend and Boxwood distributed $14,000 of it. I'm reading right here. All right, the next paragraph. Boxwood sells inventory to Lake each period. Intra-entity gross profits of $22,400 were present in Lake's beginning inventory, and its ending inventory carried $32,900 in intra-entity gross profits. So then we're asked to view these following questions as independent situations, but we're only going to tackle part A. Keep in mind the effective tax rate is 21%. So if Lake owns a 60% interest in Boxwood, what total income tax expense must be reported on a consolidated income statement for the period? Okay, now I'm showing the answer, and I'll present some table information that shows the calculations in just a moment. Okay, so what does the answer says? It says the total income tax expense is $95,065, and it points out that because of the level of ownership, separate returns must be filed, right? Intra-entity gross profits are taxed immediately, just as intra-entity dividends are. But because the intra-entity dividend gross profits are deferred on a consolidated financial statement, Boxwood expense is $16,695 or 21% of the $79,500 in net income. And they show you the calculation, $90,000 plus $22,400 minus $32,900. And Lake's income is subject to taxation, includes the $360,000 in operating income plus $37,683 in income accruing from its investment in Boxwood. And they tell you it's 60% of the after-tax income, $62,805, calculated by taking $79,500 and subtracting $16,695 from it. And then we see the calculation down below. So let me share that with you. Okay, so here you can see the logic. There's a couple ways to get to the 95,065. You can take the 360,000, then take the equity income times the taxable portion, which is 35%. And from there, you add that to the operating income to come up with income that's eventually going to be subject to taxation. Tax rate's 21%. So we come up with income tax expense to Lake of $78,370, and the income tax to Boxwood is $16,695. So the total income tax expense is $95,065. Now, another way to get to that is take Lake's operating income and then add in the dividends received net of the 65% dividend deduction, right? So that's 14,000 times 60% times 35%, right? 1 minus 65%. And that gives us taxable income of $362,940 times 21%, gives us Lake's income tax expense. Now we start off with Boxwood's income before tax, $79,500. Then subtract out the income tax expense at 21%. That's their net income. Then subtract out the dividends. That gives us undistributed income times the ownership percentage. So now we've got Lake's share of undistributed income. It also gets a dividend received deduction of 65%. So now we're down to the income eventually taxed to Lake is $10,249 with a 21% tax rate. That means we've got a $2,152 deferred tax. Then we add in the pieces, right? The 78,369 or 78,370, right? We're a small amount rounding, plus the Boxwood that we previously came up with, and we come up with total income tax expense. Okay, now I shrunk that view and moved it off to the left so that we could just focus on the journal entries involved, just as you can see what it would look like. Okay, so there's the entries you would see to record the income tax expense, deferred tax liability, and taxes payable on Lake's books. That's the top part. And then the entry that you would see on Boxwood books. Okay, now I went through this pretty quickly, So feel free, to backtrack or hit the pause and play so that you can follow the logic. Thanks, everybody.